Okay, so many people believe that the 2008 recession was the worst economic downfall since the 1930s Great Depression, and rightfully so. An estimated 2.6 million jobs were lost during the calendar year of 2008. That's the highest total in over 60 years. And what's even more staggering is that 1.6 million of those jobs were lost in the final 4 months of the year, showing an almost direct relationship between the recession and the jobs lost. In 2008, the number of employed Americans skyrocketed from 632,000 all the way up to 11.1 million. These jobs resulted in a slowed economy because, people were reluctant to spend their money because they knew that the economy was not doing well, and they knew that spending their money was not smart because they knew that they needed to save their money in order to really survive economically.
So as you can clearly see from this graph, up until about 2007, unemployment didn't reach but above about 6%. And once the recession hit, it skyrocketed up to around 10% in America.
Okay, now that we understand just exactly how detrimental the recession was to our American society, let's go ahead and dive in and view exactly what caused the recession, because that's a big part of this project. So what caused the recession? It was many things, but a couple of the biggest things were had to do with the housing market and mortgage-backed securities, which is basically a type of asset-backed security that is secured by a mortgage or collection of mortgages. So to give you a visual of exactly what a mortgage-backed security is, I drew up this visual right here. So pretty much you start off with individual single home mortgages, whether it be $1 million home here, a $500,000 home here, a $100,000 home here, and you add all these up and you put them in one mortgage pool, and so you have all the mortgages from individual homes put into a mortgage pool. And like I said earlier, these are expected to be paid off over time. They're not expected to be paid off immediately. You can't just buy them and then get your money, all of your money out of it. So, it comes with a risk, and that's exactly the risk that the United States of America took when they purchased this mortgage pool. And they purchased it for a price lower than the actual price of the mortgages. And even though it was lower, they still, as we can see, lost a ton of money. One reason the gamble did not pay off is because of a thing called a subprime loan. A subprime loan is a type of loan that is offered at a rate above prime to individuals who do not qualify for prime rates. Essentially, it's a loan given to someone who has had trouble in the past paying off their loans. In essence, it's a loan that should never have been given, but was given because greedy people were trying to make money off of the less fortunate and less educated. Okay, so not only were subprime loans given out to people that were not supposed to get them in the first place, the price of buying a home also dramatically increased. For the first half of the decade, aggressive investing by homebuyers, mortgage lenders, Wall Street investment houses, and insurers had driven up the median price of a single-family home by almost 10% a year, with housing in some parts of the country escalating even faster than that. And when prices went back down in 2007, a large number of homeowners faced rising adjustable rate mortgage payments and really could no longer borrow against a home, against a rising home value to finance other expenses. So by the middle of 2009, the median home price had fallen back to what it was really around the 2000 level, and those with heavy investments in houses, including those risky mortgage-backed securities that the United States had purchased, they found themselves all but worthless. So amidst this great recession that we had, you're probably wondering, what did the government do to offset this recession? Well, they did a lot, and one of the main things was the Economic Stimulus Act of 2008, which was an act of Congress providing for several kinds of economic stimuli intended to boost the United States economy. It created generous tax rebate programs designed to boost spending among middle and low class citizens. It helped those that were heavily affected by the recession to get back on their feet, and it also encouraged people to spend their money, seeing that they now have a little extra. The government figured that if people had more money in their pockets, they'd be better incentivized to spend that money, and in turn, get the economy flowing once again. So, what this act did was it helped the average household was rebated around $600 a year, with the less fortunate receiving upwards of $1,000 in rebates per household. Um, the government predicted that the economic downfall was going to continue if this policy had not been enacted. Um, and the policy quickly had positive effects on the economy. It was found that stimulus checks increased spending for the typical family by 3.5% when the rebate arrived, and you're thinking, that's not that much. Well, 3.5%, that's a lot more than what they were spending, which was far in the negatives. So, boosting overall non-durable consumption by 2.5% in the second quarter of 2008, that's a really big deal. I mean, this really helped out the economy. That's an immediate impact on a struggling economy that was in desperate need for upward movement.
So, all in all, the fiscal policy enacted by the United States government was extremely successful in helping United States citizens get back on their feet and helping companies also get back on their feet and creating more jobs in the United States, creating more opportunities for work, and also creating a better economy that people want to invest in and that people want to spend money in. So, overall, the fiscal policy was extremely successful in the United States.